Today, we will talk about LIBOR, what the London Interbank Offered Rate is and how it's used. The London Interbank Offered Rate was a benchmark interest rate at which major global banks lent to one another in the international interbank market for short-term loans. LIBOR served as a globally accepted key benchmark interest rate that indicated borrowing costs between banks. The rate was calculated and published each day by the Intercontinental Exchange, ICE. LIBOR was the average interest rate at which major global banks borrow from one another. It was based on 5 currencies and served 7 different maturities. The most commonly quoted rate is the 3-month US dollar rate, usually referred to as the current LIBOR rate. LIBOR impacted consumers and financial institutions, as it determined the interest rates on various credit products and had an effect on the returns on certain securities. The IBA constituted a designated panel of global banks for each currency and tenor pair. The LIBOR rate was calculated using a trimmed mean approach applied to all the responses received, eliminating a small specified percentage of the largest and smallest values before calculating the mean. LIBOR was used worldwide in a wide variety of financial products and served as a standard gauge of market expectations for interest rates. It accounted for the liquidity premiums for various instruments traded in the money markets and indicated the health of the overall banking system. LIBOR was also used as a reference rate for other standard processes like clearing, price discovery, and product valuation. The need for a uniform measure of interest rates across financial institutions led to the establishment of BBA LIBOR in 1986. Since then, it has undergone many changes, including a shift from BBA administration to ICE LIBOR in 2014. Currencies involved in calculating LIBOR have also changed, and the 2008 financial crisis saw a significant decline in the number of tenors for which LIBOR was calculated. There are several other interest rates that are popularly followed across the globe, including Euribor, TIBOR, SHIBOR, and MIBOR, which serve as alternatives to LIBOR. LIBOR has had its fair share of controversies, including a major scandal of rate rigging where major banks allegedly colluded to manipulate the LIBOR rates. This led to investigations and regulatory scrutiny, as well as heavy fines imposed on banks and financial institutions involved in the malpractice. LIBOR rates provide a useful benchmark for the level of activity in the global economy. A falling LIBOR indicates that it is becoming easier to borrow money, possibly forecasting an increase in economic activity. A rising LIBOR means that it is getting harder to borrow money, indicating a likely slowdown in business activity. Regulatory reforms have begun in recent years to replace LIBOR as the interbank borrowing rate. The new system will use actual transaction rates, with SOFR set to replace LIBOR in 2023. Other countries are also exploring using their own version of a benchmark rate when LIBOR is phased out. Floating rate bonds and interest rate swaps are examples of LIBOR-based transactions. These transactions involve variable interest payments based on LIBOR values and are used by parties looking to change the type of interest receipts, as illustrated by the case of Paul and Peter entering into a swap agreement. The rate rigging scandal raised questions about the objectivity and reliability of LIBOR as a benchmark for global interest rates, leading to phasing out LIBOR in favor of other benchmarks. Several alternative indexes, including SOFR, have been proposed to replace USD LIBOR. The primary difference between LIBOR and SOFR is the method by which the rates are generated. LIBOR uses inputs from panel banks to come up with the average rate, while SOFR is based on observed transactions in the U.S. Treasury market. LIBOR was a global benchmark that represented the interest rates on short-term loans from one bank to another. However, it fell under suspicion due to a rate rigging scandal and methodological critique, leading to its replacement by SOFR in 2023. Here are 4 key takeaways. 1. LIBOR was a benchmark interest rate at which major global banks lent to one another. 2. The rate was calculated using the waterfall methodology, a standardized, transaction-based, data-driven, layered method. 3. LIBOR has been subject to manipulation, scandal, and methodological critique, making it less credible today as a benchmark rate. 4. LIBOR has been replaced by the Secured Overnight Financing Rate, SOFR, on June 30, 2023. Hope this would help. Thanks for watching.